Every week, thousands of retail investors hear a tip on social media, see that an IPO is oversubscribed, and throw their money in. They're treating the stock market like a scratch-off ticket. Usually, they're looking at the gray market premium, or GMP. This is an informal, totally unregulated number. It doesn't measure business quality, its profit margins, or its debt. It only measures the current mood of speculators. Applying just because a website predicts a 60% listing gain hands your money over blind, exposing your capital to total vulnerability. That mood can evaporate overnight. A sudden drop in the broader market between the day you subscribe and the day the stock lists will instantly wipe out all that hype. When the hype dies, the stock lists at a discount. Suddenly, your capital is trapped in a company you know nothing about, and you have no exit plan. To see the risk clearly, look at this evaluation framework. The y-axis is market hype. The x-axis is actual fundamental business quality. Most failed retail trades happen in the top left corner. High hype meeting terrible fundamentals, destroying retail capital. Prioritizing the convenience of a social media tip over fundamental analysis leads to predictable losses rather than wealth creation. To find the truth, you have to open the draft red herring prospectus. This document is the mandatory tool you need to separate real businesses from hype machines. Go straight to the Use of Proceeds section. This tells you where your money is actually going. Fresh capital means the company is taking your cash to build factories or hire people. An offer for sale, or OFS, is something else entirely. In an OFS, the company gets nothing. Your money is simply buying out the early investors and promoters. You are providing their exit liquidity rather than funding the company's future expansion. Once you know the destination of the money, check the price tag. The most efficient way to do this is with the price to earnings, or PE ratio. A PE ratio only makes sense when you compare the IPO's asking price against 2 or 3 direct competitors already trading on the stock exchange. This matrix stacks the IPO candidate against established peers. We compare PE ratios, debt levels, and return on equity. When you see a massive disparity, like an IPO priced at 80 times earnings while peers trade at 30, you're looking at an unjustified premium. Overpaying for a stock means your returns will likely stagnate. You could end up holding that stock for years while the company's earnings slowly catch up to the inflated price you paid on day one. Checking the return on equity within this same matrix confirms if the company actually uses shareholder money more efficiently than its peers. If the ROE doesn't justify the price, walk away. Spending 15 minutes on this matrix math is the only way to protect your capital from promoter hype. Finding a fairly valued IPO is only half the battle. You also have to navigate the mathematical reality of trying to acquire shares during a massive oversubscription. When total bids come in, the allotment engine hits a decision node, proportional allocation, or a blind lottery. In a lottery, regulators enforce a specific rule. The system must provide one minimum lot to every successful applicant before anyone receives a second lot. Because of this rule, applying for the maximum allowed shares from a single account is useless for retail investors. It doesn't improve your odds of getting that first lot at all. A more effective strategy is applying for a single lot at the cutoff price, using multiple Demat accounts tied to different family members. This requires the administrative effort of managing several different family accounts and bank mandates, but it is the only way to mathematically optimize your odds in a lottery. Understanding this math separates strategic applicants from frustrated gamblers. If you successfully receive your shares, your next major decision happens after the listing. You have to decide whether to hold through the initial volatility. This decision depends on the anchor investors. These are large institutions that commit millions before the IPO opens to help build market confidence. However, these institutions are legally restricted from selling their shares immediately by mandatory lock-in periods. This timeline starts at day 0. Blocks underneath represent millions of institutional shares locked away. At day 30, 50% become eligible for sale, which can drive prices down. The remaining shares unlock at day 90, creating another supply shock. Tracking this calendar prevents you from panic selling when institutional profit booking causes a temporary price crash.
knowing these specific dates turns a terrifying portfolio drop into a predictable, manageable market mechanic. Subscription numbers and GMP only measure current demand. They tell you nothing about the future resilience of the business. You must choose between two paths. On the left, the listing day flipper builds their strategy entirely on institutional oversubscription data. As a flipper, you might capture short-term pops, but you must accept extreme volatility and have the discipline to sell immediately on day one. On the right is the long-term owner, who relies on the fundamental matrix and the DRHP. As an owner, you weather the 90-day anchor lock-in turbulence, but you acquire a high-quality asset at a fair valuation for long-term compounding. You must consciously choose one of these lanes. Mixing these strategies, like buying for a listing pop but holding through a crash, guarantees failure. Every application you submit is a legal claim on the future of a real, functioning business. Either commit the 15 minutes to do the fundamental matrix math, or protect your capital by sitting the hype cycle out completely.